two numbers, okay, which are very critical for this. The one is the revenue growth. Revenue growth, we were expecting 10%. It has come at 7%. It is below what Street was expecting. That is a minus sign, okay. Second thing, margins, okay. 9% margins compared to expectation of around 11%. Again, it is way below what people were expecting. Now, I'll tell you why the stock will be correcting or will be in red on Monday. Because compared to last quarter, which is quarter 4, the stock has already run up 28%, okay? We were watching this stock around 1250 when we were talking about quarter 4 results last time. And now the stock is standing around 1550, 1560. You know, after this super run up what the stock has seen, we are not seeing those numbers, you know, which are coming in there. So I will not be surprised that the stock takes a beating on Monday clearly. And, you know, you can see, you know, none of the numbers, you know, as you said, there were 4 important numbers we were watching out for. Revenue growth, which is below what we were expecting. EBITDA, absolute EBITDA, below. EBITDA margins below. Order inflow, they are in line. So we are not seeing any surprises in terms of order inflow. We're expecting 30,000 crore. It has come around that 30,000 crore mark. But, you know, 9% margin, again, I will be like a broken record. But, you know, you can't expect 9% after what we have seen, you know, from L&T last quarter. And, of course, you know, after what we have seen, a super run up in the stock.
Well, agreed. Definitely a miss as far as numbers is concerned. No denying the fact. Everything, even the order inflow, as you mentioned, is in line. No surprise on the upside. Also, one thing that I'd like to mention is the infrastructure segment margin, because that is one thing that the street watches out for. The margin this time came in around 7.3% versus 6.7%. So again, nothing out of the blue there. This is what the kind of numbers we were expecting. And in fact, something better that we were expecting. Thankfully, this time the company has not reported losses in any of the segments. So the management had told us earlier that the hydrocarbon segment is out of the red, and now it starts reporting profits that seem to have come about. But as far as the infrastructure segment, which is the mainstay for the company, not very good numbers coming in there. So the infrastructure fresh orders is 11,800 crores, which is a decent number. But there also, if you see, the international orders still continue to be high at 23%. And this has been a concern with the street, that the domestic execution of the company is not really picking up, because the margins as far as the international orders is concerned is a bit less, and that is why we are seeing the margin impact. The order book there has grown by nearly 12%, and the segment margin, as I said, 9.2% versus 8.9%. So a paltry improvement there. So nothing worthwhile. Yes, I agree that the stock should correct looking at these numbers, given the fact the run-up that it has seen. If you look at the return on capital employed for the company for the last 3, 4, 5 years, it has been around 12%. There have been no improvement in terms of the EPS as well. The adjusted EPS has been hovering around the 50 rupee level. So again, we are not seeing any improvement there. The company has come out with the 5-year plan where they're talking about improving the EBITDA margins, 120 basis points, etc. But right now, it's not coming in the numbers.
You know, Anisha, I will not be surprised if the stock is down 5-6% on Monday morning, okay? We can get into more and more details, but, you know, the most important 2 numbers everyone watches is the revenue and the EBITDA.
Margins, correct.
You know, and if revenue are way below, or at least 3-4% below what we're expecting, margins at that 8.7, 8.8% mark, you know, are way below what anyone was expecting. You know, we can do whichever surgery we want to do in terms of numbers, but, you know, clearly, you know, we'll ask some of our, you know, guests who are there. I think Pankaj is there from Equirus. Pankaj, what did you make out of these numbers? Pankaj, can you hear me?
Yeah.
Pankaj, your first reaction on L&T? Okay, Mr. Diwan, if I can come to you, what is your first reaction on L&T numbers?
I think very clearly, this is what happens when stocks run up ahead of earnings, and, you know, especially heavyweight stocks, bellwether stocks, which always have had a premium. To justify that kind of a high premium of 25 times or whatever on a trailing basis, if you can't clock at least one of the 2 things upwards, either revenue growth or either improvement in margins, there's no point, you know. So I'm fine if the company got additional business from this thing, you know, from new orders, but compromise on margins. Here they've compromised on both the things. So that's a sad part. You know, you can't keep on generating business at lower margins. You can't even grow your margins, you know, from some sort of a specialist execution skill set. That's where you don't stretch that premium. And I think the run-up, as you said very correctly, has been a bit too early, too ahead of earnings. And that's where the stock will pay a little bit of a price. Some consolidation is important, and then we'll probably hear the management.
So how much fall you see on Monday, Prakash?
I see the fair value given these earnings should not be more than about 1380 or 1385 according to me. You know, so it would probably test that 1400 milestone. And very
Okay.
clearly, it would probably consolidate from there on and see how, the domestic execution starts taking off. Orders is one thing, but execution of orders
I
is
agree.
the key part.
Okay, Devan, just hold on. Rohit Natarajan from IDBI Capital is also with us. Rohit, your first reaction on the numbers?
See, yes, definitely these numbers are disappointing because what we are looking at is primarily the headline numbers. Also, when I go into this segmental reporting, yes, as somebody pointed out earlier, that the losses or in the red, those things are not there. But even having said that, the execution front has a bit slowed down, so we need to get clarity on that, what exactly is the reason. But if you observe some of the proprietary databases that we had, we made a very clear statement that the execution pace is a bit low. So the key thing to be watch out is what is the management commentary like, whether are they going to shift the guidance? I mean, because I don't think in Q1 will be a decisive factor for them.
Well, hi Rohit, Anisha here. And would you take any heart from the order inflow number that we have seen, or the margin miss is too much to be ignored right now?
Yeah, but what is the order inflow? I mean, I haven't got to the order
So it's
inflow.
29,000 crores, very close to the number that we were expecting, 30,000. But 29,700 is the number, 14% growth year on year.
And I don't think that should be a sticking point because order inflows in terms is the outlook continues to be robust. If you see the last year base ordering were a bit low, so that may help this company. And also apart from that, you have to understand that they already have a good pipeline of 2.5 trillion order backlog. So those things may not be a real key decisive factor that will not change the shape of dial. So let's see what exactly the management commentary is all about, and then maybe we can give a more better color to it.
What are you looking out for in management commentary?
See, in management commentary, the first of all, if there is any structural problems that in terms of order, I mean, is there any issues that is coming up? Would there be, a system? I mean, the kind of EBIT margin that they have posted is definitely shocking. But is there a non-linearity aspect to it? Would they be recognizing a higher portion of revenue in maybe in Q4 like they did in the last year? So these things are definitely more important.
So Rohit, I understand Q1 is a very small portion of L&T's annual numbers, but do you think the guidance that they have given can be questioned now?
See, first of all, if you look at the guidance historically, the sales guidance especially has been by and large a miss. So I'm not really too sure how the street would look into that particular aspect. But nevertheless, let's give them the benefit of doubt that they may maintain it. And Q1, they definitely, I'm sure, by Q2 that will be a better in a better position to shift the goalpost at that stage rather than doing it now.
So Rohit, looking at the numbers right now, not hearing the management commentary, but how do you see the stock reacting on Monday, given the fact that it's already at a premium, it's running at over 20 times its forward earnings, which is much above the historical mean, we know that. So what kind of correction or reaction you are seeing in the stock on Monday?
See, if you look at the correction historically, post results has been as wide as 5 to 7 odd %. And on the flip side, that is on the good side, it turns out to be definitely 5 to 7% on the upside as well. So yes, that what the initial knee-jerk reaction will be there, but we have to understand that the investors, by and large, who are the big investors who have invested there, they are of the opinion that Q1, perhaps, like I said earlier, will not be a key decisive factor to change their active portfolio weights. So we will have to wait and see, first of all, what the management commentary is. Like I said, without knowing that, it will be too difficult for me to make a figure on this.
Anisha, on that thing, my sense is, okay, and this is purely my sense, okay, for FY18, the expected EPS in the market is around 60, 65. Okay, even if we take it 65, because I remember a lot of upgrades came on L&T, after Q4 results. The stock is trading around 24 times. And with these kind of EBITDA margins, I am sure that no one on the street will believe that, that this stock should trade above 20 times or 21 times. So even if you have to shave off 3 points, and have that, updated model of yours. So I will not be surprised if the stock is down by nearly 100 rupees on Monday, because you have to adjust that upgrades which came last quarter in this. I totally agree with all of you, that Q1 is the weakest one. But even then, you talk to anyone on the street who was following L&T and whose polls we collated, everyone on the street expected 10.5%, 11%
Yes,
margins,
yes,
okay,
yes.
even in spite of knowing that it is quarter 1. So, if it has to come to 21 times earning multiple for FY18, you have to shave off at least 3 points, which means, clearly the stock moving down by 100, 120 rupees on Monday.
Yeah, Varinder, I agree with you. But my only sense was quarter 1, as you rightly mentioned, is very small portion. And after quarter 4, the run-up that we had seen, it seemed like fundamentally the street was factoring in the execution being better. I'm just giving the benefit of doubt to the company in the sense, first quarter is as it is slower, the margins and also the Ind AS impacts come in. So just need to understand what the nitty-gritty is. But yes, on the face of it, nothing really positive coming out of it. Infrastructure segment, that is the key thing there. And that is what I would like to ask to Pankaj if he is online with us. What he makes of the infrastructure segment margin, that is coming at 9.2% versus 8.9% that there was. So no improvement coming in there. And that was the key point which the analysts were saying at the time of re-rating, that they are banking on the execution of infrastructure segment.
Yeah, I think this is something which is very important for them because it's the largest segment and the more important segment for L&T.
Pankaj, we'll just have to stop you. The L&T management is speaking. Let's move on to that.
Mr. R. Shankaraman, Chief Financial Officer and member of the board, will take you through the presentation. And he will be joined by Mr. S.N. Subramanian, Deputy Managing Director and President, and the member of the board for the Q&A session. I would request all of you to restrict your questioning to the Q1 numbers and stick to the L&T Q1 numbers. Mr. Shankaraman.
So good afternoon to all of you. Warm welcome to the media meet on the group's performance results for the quarter ended 30th June 2016. I start my presentation with the usual disclaimer about forward-looking statements that this presentation could have, which could change with time and future developments. The company has done well, and I'm happy to report that in weathering the challenges that the country is facing in reviving the stalled engines of growth, namely rural demand and private investment. Hopefully, with good monsoons and passage of economic and policy reforms, both the country and the company is hopefully headed for better times. On that note of optimism, let me turn around to how we have performed as a group. The company has done well on most of the parameters that it is measured for its performance. The orders have increased by 14%, and these are comparable numbers to the first quarter numbers of the previous year. The order book consequently has grown up by 8%. Revenues have increased by 9.1%. EBITDA has gone up by 16%, and profit after tax has gone up by 46%. It's important to bear in mind that we are reporting the financial numbers prepared based on the new accounting standards, Ind AS as it is called. And we have also taken effort to convert and restate the numbers of the previous year's first quarter on Ind AS basis, and both these have been reviewed by the auditors. Looking at the parameters individually, the company as a group, among all its portfolio of businesses, have recorded orders worth 29,700 crores, which is a 14% growth over the 26,000 crores that we reported in quarter 1 of the previous year. Much of the growth has been on account of the order win that we've had in hydrocarbon business in the Middle East, a large order that we received from Saudi Arabia. And in contrast to the 69% growth in the order inflow of the international business, the order inflow of the domestic business has declined by 9%. This is on account of much of the projects that we were targeting in the domestic markets have been deferred for awarding, and they did not move adequately in quarter 1. And consequently, the infrastructure sector, which provides the bulk of our order inflow, did not report any growth in terms of fresh orders. And that overall impacts the domestic order procurement of the company. The order book, however, has grown to 2,57,000 crores, which is an 8% growth over the previous year. And the international orders account for 29% of the total order book that we have as of 30th June 2016. The order book is as a result of 40% of the orders for the current quarter coming in from infrastructure sector. The 29,700 crores is largely contributed by the 11,000 odd crores that we have picked up from the infrastructure sector. Hydrocarbon sector has joined the party in the quarter with this large order that I spoke to you about, and they account for 27% of the total order inflow for the quarter. All the services business, the information technology, the technology services, the financial services, all of them have performed well during the quarter, and they account for 19% share of the order inflow. Just for clarification, the revenue that are earned by these businesses are taken in as orders for the purpose of accounting completion. The order book of 2,57,000 crores has bulk of it from infrastructure sector. 74% of the order book is on account of the work that we need to do in the area of infrastructure. And this reflects the thrust and the focus of the country as well. The regions that we work in, India, Middle East and the neighboring regions, have taken upon themselves to develop infrastructure segment. Consequently, the infrastructure sector bags the substantial portion of the order backlog. We have 21,500 crores of orders to be executed in the hydrocarbon sector, and we have 16,900 crores of work to be executed in the power sector. The rest of the sectors account for the balance in the order book. Shifting to performance of the company in terms of revenues and profits, the revenue from operations grew by 9%. For the quarter in question, we had revenues of 218 billion rupees, and 76 billion of this 218 billion rupees came in from international contracts that we are executing. That takes the share of international revenue to total revenue to 35%, up from the 32% of the previous year's first quarter. Thanks to the global commodity prices and the general slowdown, the input costs have remained pretty stable, and hence there is no significant increase in the manufacturing, construction and operating expenditure of the company. And the amount of 136 billion reflects the current level of activity for projects under execution. The finance cost of the financial services is nothing but the raw material that the financial services business use, and hence they are stated as a line distinct from the interest cost that we run for all the funds that we employ. The finance cost of the financial services business and the finance lease activities are at 13.22 billion, 11% growth over the previous year's first quarter numbers. Staff cost at 34.2 billion is up 9%. It reflects the staff augmentation that we have for executing the jobs that are under progress, and the staff augmentation in the services business. The fact that nearly 35% of our revenues come from international business also means that much of the staff incrementally are also those added in those geographies. Sales, administration and other expenses at 15.74 billion rupees is up 16% as compared to the similar line item for the previous quarter. And the increase that you see is largely on account of the provisioning that we are required to make for non-performing assets for the financial services business and the other recoverable business for the rest of the portfolio of the businesses. It might be of interest for you to note that the new accounting standards in AS enables us to make provisions for anticipated credit losses, and that was not the case until the introduction of these new standards. So consequently, the provisioning that we had to do to comply with these accounting standards have also contributed to the increase of 16% that you see in the sales and administration expenses. The total operating expenditure of the company for the quarter at 199 billion rupees is up 8%, 1% lower than the increase in revenue at 9%. Consequently, EBITDA at 19.05 billion rupees is up by 16%, and the EBITDA margins have increased by 50 basis points from 8.2% to 8.7%. The interest expenses that the group is incurring on account of the funds that it employs for its various businesses have reduced by 13% from 3.89 billion rupees to 3.37 billion rupees. It's reflective of the level of borrowings that we run and the credit conditions that we operate in. We do believe that the interest rates could tend to remain soft given better than past monsoons, and hence the relief that it could provide on the inflationary lines. Depreciation remains stable at 4.65 billion rupees. Other income has increased by 7% at 3.02 billion rupees, largely reflecting the gains that we've had from managing the short-term money as part of our treasury operations all across the group. After providing for taxes, the net profit after taxes at 6.1 billion rupees is up by 46% as compared to 4.19 of the previous year. I once again wish to remind you that the numbers of the previous year's first quarter have been restated to be in line with the new accounting standards with which the new current quarter is getting reported. We have 9 segments. We historically used to have 10 segments, but with the shrinkage of business in the machinery, in the metallurgical and material handling business, the thresholds for segment reporting is not met, and consequently, material handling and metallurgical business have been classified as other segment. But the rest of the segments are as you have seen in the past. Taking each of these segments for some details, infrastructure segment, which is our largest segment, has seen revenue growth of 9%, quite similar to the growth of the group revenue. The revenue earned by the infrastructure segment is at 90.67 billion rupees. And 30.32 billion of this is on account of international revenues, the jobs that we execute for the infrastructure segment in overseas markets. The growth of the international revenue, in contrast to the overall growth of revenue at 9%, is 20%. The EBITDA margins have increased for this large segment by 30 basis points from 8.9% to 9.2%. Moving on to power segment, the jobs under executions have progressed well during the quarter, and that is reflected from the income from the projects under execution moving up from 10.78 billion rupees to 17.22 billion rupees, a 60% growth. With the progress on the Bangladesh gas orders that we have won, the share of international revenues have increased 3 times from 1.06 billion rupees to 3.45 billion rupees. Consequently, the EBITDA margin have increased from 1.2% to 5.8% for the quarter in question. I must once again remind that the project businesses, the margins and the orders and the revenues do not accrue uniformly, and there would be quarterly volatility which will ultimately level out in line with our guidance for the end of the year. Hydrocarbon segment has seen a flat revenue of 21 billion rupees as compared to the quarter 1 of the previous year. This is largely reflective of the late accretion to the order book of hydrocarbon segment in the previous year. We do believe with the progress on those jobs on hand, we should be able to see better growth on hydrocarbon revenues going forward. Nearly 50% of the revenues that we get from hydrocarbon segment is on the international markets. Much of it is in the Middle East, and hence out of the 21 billion rupees, 10 billion rupees are on account of international contracts that we are executing. The margins have remained stable because of the mix of the jobs, as well as last of the legacy projects which has caused us a lot of pain in the past years is coming to an end, and hence we find that going forward the margins between the second and the fourth quarter of the year would see an upward tick from the current 2% that you see for the quarter 1. Heavy engineering business, which has process plants and nuclear equipment as well as defense, has seen a 6% growth in its revenue at 6.53 billion rupees as compared to 6.19 of quarter 1 of the previous year. Like hydrocarbon business, we do export a fair bit to international markets, and hence almost a third of the revenues of the heavy engineering segment is for jobs that we execute against overseas orders. The international revenues for the quarter is at 2.6 billion rupees, up 22% from the 2.1 billion that we have. If you recall, in the Q1 of the previous years, we had to absorb delivery charges, late delivery charges and liquidated damages on some of the contracts that we were executing beyond the stipulated contractual timeline, and hence the margins of the first quarter of the previous year had taken a knock. But with the current quarter, all the projects going on course and on schedule, the margins have improved from 8.9 to 14.9, and it is beginning to resemble more of the margins spectrum that heavy engineering business provides. Electrical and automation business, the overall industry, switchgear industry, is reflecting the very weak industrial demand, and on the back of two failed monsoons, very poor offtake in the agricultural sector. The slowdown in the real estate sector have also contributed to the business fortunes of the electrical and automation business. The revenues of the electrical and automation business at 9.31 billion rupees is lower by 3% as compared to the revenue of the previous year, first quarter of the previous year. It is important to note here that the standard product business has done well within the portfolio of electrical business. It is the project business that has lagged, causing the overall decline in the revenues. The margins, however, on the back of improved performance by the standard product business is improved from 5.8% to 7.8%. Coming to technology services and information technology, as legal entities, these are two different entities, but for segment purposes, for the purposes of reporting at the group level, they reflect similar business profile, risk and reward wise. Consequently, they are clubbed together as a single segment, and we call it as information technology and technology services. The revenues have grown by 15% in this segment, from 20 billion rupees to 23.53 billion rupees. The business have also done well to get rid of accounts which are unproductive, improve their operational excellence, improve their resource optimization. Consequently, we see a healthy increase in their EBITDA margin from 18.4% to 21.9%. And we do believe that these improvements would continue to stick with the business in terms of margins. Developmental projects is a portfolio of projects that we have in terms of toll roads, power plant, the metro job, as well as the realty segment. We have, because of the new accounting standards, IDPL, which is the holding company for all the toll roads, are treated as not as a subsidiary. They are treated as a joint venture because we share control in that company with Canadian pension funds. And according to the new accounting standards, wherever we don't have majority control over business, they are not treated as subsidiary regardless of shareholding pattern. So in consonance and compliance with the new definition of what constitutes a subsidiary, the developmental projects revenue line that you see excludes the revenue of the toll roads. However, in terms of margin, profits of the developmental project business gets aggregated, and it is only taken in as share of profit or loss from the joint venture. So the revenues that you see here largely represents the revenues from the power business that we run, the power project that we have in Nabha, in Punjab. The business has seen higher offtake from the Punjab State Electricity Board. They procure power based on merit order, which means the cheapest supplier of power would get the first priority for supplying power, and consequently we have seen the PLF go excess of 90%, and that reflects in improvement in the revenue. The margins consequently has also increased from 5.9% to 9.8%. Financial services business has grown their top line by 17%. I would have seen that in the results announced by the financial services business a few days ago, from 17.8 billion to 20.91 billion. And the EBITDA margins have improved from 11.7% to 13.3%. With the renewed focus on pursuing business which are margin accretive and return accretive, the portfolio of financial services is getting more skewed towards sectors that are going to have better potential in terms of return on the invested capital. The other segment, which is the final segment, is a collage of the rest of the segments. We have realty, we have shipbuilding, we have machinery industrial products. And the segment has seen a decline in revenue from 19.41 to 16.21 billion rupees. This is largely reflecting a very weak industrial demand, and that is reflected by the lack of growth in the machinery and industrial products business, low capacity utilization of businesses like valves and welding systems. And also the realty business, the stock of apartments that we have developed to sell in phase 1 is fast coming to an end. Much of this inventory has been sold, and we are awaiting permission and approvals for the phase 2 of these projects, both at Powai and Parel in Mumbai and in Bangalore. And we would see that on the back of those permissions, as and when received, we will see the revenues from the realty segment pick up. But the decline is not reflective of the demand, the decline is reflective of the lack of inventory that we have. Insofar as shipbuilding is concerned, we are still awaiting the government's ordering on private sector, and we are well positioned to benefit by the policy shift. And until that happens, the capacity utilization for the shipbuilding will be low, and it will carry the under recoveries, which will be reflected by losses from that business line. To add to that, we had reported in the past quarter about some cancelled ships, and we had to provide for inventory write-down of these cancelled ships, and hence the margins are down from 12% to minus 0.2%. But the inventory write-down is one-off, and with the, hopefully, with defense orders, the future would throw up better numbers. With this, I conclude my presentation and throw open for Q&A. Thank you very much.
Ladies and gentlemen, we'll be joined by Mr. S. Subramanian for the Q&A.
Yes, sir. Can you give an idea about the kind of order growth you see given the fact that some noise is coming, it's just going up? For record. Yeah. Sanjeev here from Bloomberg Quint. Just wanted to get an idea about the kind of order book growth that you can see in FY17, given you're seeing good pickup in hydrocarbons and infrastructure space, but there's certain sectors like machinery and all where you aren't seeing much of the growth. So what kind of order book growth came into that?
When we've done well in quarter 1 in terms of order procurement. Of course, few bulky orders, particularly in hydrocarbon, helped us. But when we reviewed the prospects, the pipeline continues to look robust. And we do believe that the guidance that we have given in terms of 15% growth in fresh orders and somewhere between 12 and 15% growth in revenue, we should stay on course. Consequently, the growth in the order book that we had projected at the beginning, order book as compared to the order inflow, could be in double digits, maybe 10-11%.
So currently you are holding on to the guidance which you provided earlier?
Yeah, there is nothing that seems to suggest to us at this point in time that we have to reverse, because much of the work that we were planning to do, anyway we're back-ended in this year,
right,
in terms of fresh orders.
Right.
The bidding activity continues.
Right. Just for the record, this is Ajay Sharma from BT now. Sir, all the three matrices, top line, bottom line, EBITDA, you missed this time around significantly. And at the same time, the outlook, which suggests in the press release, is extremely sluggish. We would like to understand from you how much of the miss has actually come on ground of, because of Ind-AS, because you had given a presentation to the exchanges earlier, indicating that you'll be regrouping the numbers. But there's a big miss. And the outlook is also extremely cautious. How much of it is because structural slowdown in your in the areas you operated, and how much is it because of the regrouping of the numbers?
See, I don't know in what context you're talking about miss, because in our assessment, we have grown on all the parameters if you restate the numbers of the previous quarter. If you are holding on as reference point numbers of the previous quarter based on the earlier accounting standard, then obviously you might possibly come to a conclusion that there is a miss. But I think that is not the way to look at it, and which is the reason why we have taken trouble, even though we are not required by regulations to restate until later in the year the previous quarter's numbers. We have restated for you to get confidence that the company actually has grown on most of the parameters as I spoke to you about. Insofar as the outlook looking cautious, I think we've spoken about it in the past in this very room. We are very investment led for business growth, and investment is going to be a combination of policy plus funding. And unless we see clear visibility and traction of these investments, our order inflow still continues to be RFPs, bid submitted, award awaited. It is on that path.
Right. So, quick follow-up, this time what is happening is that up till now your global order book has remained sluggish, but that has shown growth this time round, whereas the local business has shrunk. And the global business has also come because of one big lumpy order from Saudi Aramco, if I'm not wrong. So is that also at risk if the capex-led recovery which you have indicated in the release does not really pick up steam? Then do you think your guidance comes at risk mid-year or something like that?
See, we are not at mid-year, so it's not appropriate to speculate where we will be in the middle of the year. But as far as our guidance is concerned, as I mentioned to you, that our business is lumpy. We can't help it. I mean, we are big boys in infrastructure, so we will be beneficiary of lumpy orders, and these don't come uniformly. So there are going to be spikes in the quarters. But all that I can tell you is that the usual caution that has to overlay any investment decision is something that is reflective in our pronouncements. But from a business positioning point of view, from capability positioning point of view, if those investments were to happen in these sectors, I think L&T will be a big beneficiary. So that's the status, and that has not changed since we last spoke.
So, Kevin here from CNBC.
Yeah.
Could you just give us an idea of your margins in the infrastructure segment, both internationally and domestically?
See, the combined margins you saw was 9.3%, and as a portfolio, it's a business which would provide about 10% margin, and this takes into account the combination of domestic and international. It's very hard to exactly or precisely say what will be the share of international, what will be the share of domestic. It depends on which orders gets opened, which gets awarded and stuff like that. But it is safe to assume that the portfolio would yield 10%, which is about the best margin percentage for a EPC company operating in this part of the world. And that is because of the way we run our business in terms of the business model and the stance, the market share we have.
But also understand international business, there's hardly any inflation in those countries as yet. 2, you earn in dollar-linked kind of payments. And 3, the bank interest rates are also much lower than what is there in our country. So having said that, even if you earn a slightly lower margin there, in our view it is substantially same as what we earn out here, because here we have to contend with inflation, exchange fluctuations, as well as higher bank interest costs. And therefore that neutralization does take place.
But it middles out at 10% overall.
Yeah, that's what Shankar said right now.
Can you give us a feel of how Ind AS would be impacting your balance sheet, because we don't see the large amount of IDPL revenue coming in and reflecting in your consolidated numbers. Okay. If that is the case, how did that venture perform? And secondly, there's something called other comprehensive income which comes in the bottom line after minorities. What is that?
Sure. See, fortunately, much of the accounting practices that we have been following as a company has been in alignment to the international practices. So in terms of adjustment, there has not been any major accounting adjustments that we were required to be making. The one fundamental change that has happened is, in the past, subsidiaries were defined as such based on the shareholding. Today,
they go beyond the shareholding percentage and see who controls the enterprise. If you have control over the affairs of the company, it is regarded as subsidiary, and if you don't have controls over the affair of the company completely, as is the case in any of the joint ventures, then it is called as a non-subsidiary, and for non-subsidiary you are not required to consolidate the revenues. However, the profitability of that venture has to be consolidated as a single line as profit or share of the subsidiary joint venture. Insofar as balance sheet is concerned, in the past when we were consolidating the subsidiaries, all these assets were added line by line. Today those assets need not be added, but the investments that we have made into those subsidiaries will be appearing as a line item, adjusted for the profit or loss that the venture makes. So the essence of the balance sheet is retained, the line items vary, the size appears to shrink in terms of those assets not being there, but the ultimate essence of the amount invested, the returns that are made doesn't change, number one. Number two, you asked about the two large subsidiaries, which are formerly subsidiaries which are not